Tax Reform Highlights, Part 1. For 2018, most tax rates have been reduced. The 2018 rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. In addition, for 2018, the tax rates and brackets for the unearned income of a child, kiddie tax, have changed and are no longer affected by the tax situation of the child's parents. The new tax rates applicable to a child's unearned income of more than $2,550 are 24%, 35%, and 37%, the same rates used by trusts and estates. Personal exemption deductions for taxpayer spouse or dependents have been eliminated beginning after December 31, 2017 and before January 1st of 2026. For 2018, the basic standard deduction is $12,000 for singles, $18,000 for head of households, and $24,000 for married couples filing a joint return. Higher amounts apply to people who are blind or at least age 65. Taxpayers may be able to deduct mortgage interest only on the first $750,000, $375,000 if married filing separately, of indebtedness. Higher limitations apply if deducting mortgage interest from indebtedness incurred on or before December 15, 2017. No matter when the indebtedness was incurred, taxpayers can no longer deduct the interest from a loan secured by their home to the extent the loan proceeds were not used to buy, build, or substantially improve the home. In other words, interest on a home equity loan that is not used to buy, build, or substantially improve the home are no longer deductible. Changes have been made to the deductibility of state and local taxes, including income taxes or general sales tax if elected instead of income taxes, real estate taxes, and personal property taxes. The total deduction for state and local income, sales, and property taxes is limited to a combined total deduction of $10,000, $5,000 if married filing separate. Any state and local taxes paid above this amount cannot be deducted. No deduction is allowed for foreign real property taxes. More itemized deduction changes. First, the old rule that limited total itemized deductions for certain higher income individuals has been suspended. Second, deduct certain unreimbursed medical expenses that exceed 7.5% of adjusted gross income. Before this law change, unreimbursed medical expenses had to exceed 10% of adjusted gross income for most taxpayers in order to be deductible. Third, the limit on charitable contributions of cash has increased from 50 to 60% of adjusted gross income. Fourth, net personal casualty and theft losses are deductible only to the extent they're attributable to a federally declared disasters. Claims must include the FEMA code assigned to the disaster. The loss must still exceed $100 per casualty, and the net total loss must exceed 10% of AGI. In addition, taxpayers can still elect to deduct the casualty loss in the year immediately preceding the tax year in which the disaster loss was incurred. Lastly, The previous deduction for job-related expenses or other miscellaneous itemized deductions that exceed 2% of adjusted gross income is suspended. This includes unreimbursed employee expenses, such as uniforms, union dues, the deduction for business-related meals, entertainment, and travel for employees, as well as any deductions that may have previously been claimed for tax preparation fees, investment expenses, including investment management fees, safe deposit box fees, and investment expenses from pass-through entities. Alimony. Alimony and separate maintenance payments are no longer deductible for any divorce or separation agreement executed after December 31, 2018, or for any divorce or separation agreement executed on or before December 31, 2018, but modified after that date. Further, alimony and separate maintenance payments are no longer included in income based on these dates. Note that this does not relate to tax year 2018 per se. This is a change that will be most impactful in 2019 and beyond. Moving expenses. For tax years beginning after 2017, taxpayers can no longer deduct moving expenses unless they are a member of the armed forces on active duty and due to a military order for permanent change of station. Child tax credit and credit for other dependents. For 2018, the maximum child tax credit has increased to $2,000 per qualifying child. Up to $1,400 of the credit can be refundable for each qualifying child as the additional child tax credit. In addition, the income threshold at which the child tax credit begins to phase out is increased to $200,000 or $400,000 if married filing joint. On new credit, the credit for other dependents of up to $500 is available for each of the qualifying dependents other than children who can be claimed for the child tax credit. The qualifying dependent must be a U.S. citizen, U.S. national, or U.S. resident alien. The total of both credits is subject to a single phase-out when adjusted gross income exceeds $200,000 or $400,000 for married filing joint. Beginning with tax year 2018, children must have a Social Security number issued by Social Security Administration before the due date of the return, including extensions, to be claimed as a qualifying child for the child tax credit. Retirement and savings plans. Conversion from a traditional IRA, SEP, or simple to a Roth IRA can no longer be recharacterized back. The new law also prohibits recharacterizing amounts rolled over to a Roth IRA from other retirement plans such as 401k or 403b. Taxpayers can still treat a regular contribution made to a Roth IRA or to a traditional IRA as having been made to the other type of IRA. If employment is terminated or if the plan is terminated with an outstanding plan loan, a plan sponsor may offset the account balance with the outstanding balance of the loan. If a plan loan is offset, the participant has until the due date, including extensions, to roll over the loan balance to an IRA or eligible retirement plan. More can now be contributed to an Achieving a Better Life Experience, ABLE, account. You may also roll over limited amounts from a 529 qualified tuition program account of the designated beneficiary to the ABLE account of the designated beneficiary to their family member. Beginning in 2018, the retirement savings contribution credit or savers credit can be taken for contributions to an ABLE account if the taxpayer is the designated beneficiary. One of the Tax Cut Job Act changes allows distributions from a 529 plan to be used to pay up to a total of $10,000 of tuition per beneficiary, regardless of the number of contributing plans, each year to an elementary or secondary, that's K through 12, public, private, or religious school of the beneficiary's choosing. In other words, 529, the usage has been expanded to elementary, secondary, public, private, religious. Opportunity zones. An opportunity zone is an economically distressed community where new investments, under certain conditions, may be eligible for preferential tax treatment. Localities qualify as opportunity zones if they have been nominated for that designation by the state, and that nomination has been certified by the Secretary of the U.S. Treasury via his delegation of authority to the IRS. Opportunity zones were added to the tax code by the Tax Cut and Job Act on December 22, 2017. Investors can defer tax on any prior gains invested in a qualified opportunity fund until the earlier of the date on which the investment in a qualified opportunity fund, or QOF, is sold or exchanged, or December 31, 2026, the earlier of those dates. If the QOF investment is held for longer than 5 years, there is a 10% exclusion of the deferred gain. If held more than 7 years, the 10% becomes 15%. Second, if the investor holds the investment in the opportunity fund for at least 10 years, the investor is eligible for an increase in basis of the QOF investment equal to its fair market value on the date that the QOF investment is sold or exchanged. Qualified business income deduction. Beginning in 2018, taxpayers may be able to deduct up to 20% of their qualified business income from a qualified trade or business, plus 20% of qualified real estate investment, REIT dividends, and qualified publicly traded partnership, PTP income. The deduction can be taken in addition to standard deduction or itemized deductions. The deduction has two components. QBI component. This component of the deduction equals 20% of QBI, qualified business income, from a domestic business operated as a sole proprietorship or through a partnership, S-corp, trust, or estate. The QBI component is subject to limitations depending on the taxpayer's taxable income that may include the type of trade or business, the amount of W-2 wages paid by the qualified trade or business, and the unadjusted basis immediately after acquisition of qualified property held by the trade or business. It may also be reduced by the patron reduction if the taxpayer is a patron of an agricultural or horticultural cooperative. This component of the deduction equals 20% of qualified REIT dividends and qualified PTP income. So this is the second component, the REIT PTP component. This component is not limited by W-2 wages or by basis of qualified property. Depending on the taxpayer's taxable income, the amount of PTP income that qualifies may be limited depending on the PTP's trade or business. the deduction is limited to the lesser of the QBI component plus the REIT/PTP component, or 20% of taxable income minus net capital gains. So that's a limitation. So 20% of the income from our components cannot exceed 20% of taxable income minus any net capital gain. The threshold amounts at which the type of business or W-2 and basis do not matter are $315,000 for a married couple filing a joint return, or $157,500 for all other taxpayers. Estate and gift tax. Under the new law, the basic exclusion amount for an estate tax return with a 2018 date of death increases to $10,000 before taking into account necessary inflation adjustment. So after considering inflation, the basic exclusion amount for 2018 is $11,180,000. Likewise, the basic exclusion amounts for gifts is the same, $11,180,000 for 2018. So these amounts are nearly doubled. Let's look at some questions and examples. Prior to Tax Cut and Jobs Act, the limit for cash contributions as a percentage of AGI was 50%. What is that percentage now? Well, the answer is 60%. These are cash contributions. So are specifically related to cash contributions to the appropriate organization. 50% is now 60%. The Tax Cut and Jobs Act increased the maximum refundable portion of the additional child tax credit to, well, it's $1,400. The child tax credit has gone up to $2,000, but the refundable portion has gone to $1,400. Ida engaged in a not-for-profit activity or hobby. The income and expenses are as follows. It's gross income and then various expenses. Real estate taxes, $700, mortgage interest, $900, insurance, $400, utilities, $700, maintenance, $200, depreciation on an automobile, depreciation on a machine. Total expenses, $3,700. That's a loss of $500. The amount of allowable depreciation for the automobile. So if we remember, we had a tier system where we would take deductions such as real estate taxes and home mortgage interest first, then other type of expenses or deductions such as maintenance next, and then lastly depreciation. Well, in that case, if it was under the old law, there would be some depreciation to be taken because we'd still have some income left by the time we got to depreciation. However, under Tax Cut and Jobs Act, these expenses, these other kinds of expenses like insurance, utilities, maintenance, depreciation, they were only allowed as a miscellaneous itemized deduction subject to 2%. And as we've studied, there no longer is a miscellaneous itemized deduction subject to 2%, or at least for a number of years there won't be. So the correct answer is 0 because of the fact that that category of itemized deductions has been suspended. And then lastly, in January of 2018, a taxpayer takes out a $500,000 mortgage to purchase a main home. The loan is secured by the main home. In February of 2018, the taxpayer takes out a $250,000 home equity loan to purchase a vacation home. The loan is secured by the main home. How much of the home equity debt is considered to generate deductible home mortgage interest? Well, in this case, it's none. But it's not so much that it's a home equity loan because the home equity loan was used to purchase a home. So that typically would be, it would be to buy, build, or improve a home. However, we can't have the home equity loan secured by the main home in order to buy another home. In this case, we call it a vacation home. So that's the reason it's none. So there's a couple things here. One is home equity debt, by and large, is no longer deductible, or the interest on a home equity loan is usually no longer deductible. But if a home equity loan supports the buying, building, or improving of the home that the loan is secured by, then it's still deductible. So this one kind of runs into the home equity loan rules, but it's a little bit different in that the home equity loan is secured by a different home than the home that was purchased, and therefore our answer is none. Well, thanks very much. I hope you found this interesting and helpful, and good luck with your studies.